So, Taylor, we just explored how charitable donations can sway the decision of whether to itemize. Now let's shift gears to another common itemization consideration: homeownership. In this scenario, we'll call it the homeowner's dilemma. We'll look at how owning a home, specifically the mortgage interest and property taxes you pay, can play a big role in your tax strategy. Imagine you're a homeowner and you're trying to decide the best way to file your taxes. You know you can take the standard deduction, which is a fixed amount based on your filing status. But you also know you can itemize, potentially deducting things like mortgage interest and property taxes. The question is, which is better for you? Sam, let's start with this. How do changes in mortgage interest rates and property taxes impact the decision to itemize?
Great question, Alex. The higher your mortgage interest and property taxes, the more likely itemizing will be advantageous. Think of it like a seesaw. On one side, you have the standard deduction, a fixed amount. On the other side, you have your itemized deductions. As interest rates rise or your property taxes increase, that itemized deduction side of the seesaw gets heavier, potentially tipping the balance in favor of itemizing. Conversely, lower interest rates or property taxes lighten that side, making the standard deduction more attractive.
So if I understand correctly, if my mortgage interest and property taxes combined are less than the standard deduction, I'm probably better off taking the standard deduction.
Exactly. It's all about which amount is greater.
And that brings us to my second question. What other factors besides mortgage interest and property taxes might influence this decision?
Several things, Taylor. Medical expenses exceeding 7.5% of your adjusted gross income can be itemized. Also, state and local taxes, SALT, including income or sales taxes, as well as any personal property taxes. Charitable contributions, like we just discussed, also play a role. Essentially, any deduction you can claim on Schedule A.
This reminds me of what we discussed about gathering records. It sounds like keeping good records of all potential deductions is crucial. If you don't have the documentation, you can't claim the deduction.
Absolutely. Those W-2s, 1099s, and supporting documents mentioned in that helpful guide are essential.
Let's say, Taylor, you live in a high-tax state and had some significant medical expenses this year. Even if your mortgage interest is relatively low, those additional deductions could push you over the threshold where itemizing becomes more beneficial.
That makes sense. So it's not just about one big deduction, but the combined effect of all possible itemized deductions. It's like building a puzzle. Each deduction is a piece, and you need enough pieces to complete the picture, or in this case, surpass the standard deduction.
A perfect analogy, Taylor.
So to recap, homeowners face a crucial decision: itemize or take the standard deduction. Mortgage interest and property taxes play a significant role, but other factors, including medical expenses, state and local taxes, and charitable contributions, can also tip the scales. The key is to calculate your potential itemized deductions and compare that total to the standard deduction for your filing status. If itemizing seems complex, consider seeking advice from a qualified tax professional. They can help you navigate the process and ensure you're making the best decision for your financial situation.